Asian markets are getting some support from reports the U.S. has tentatively agreed to save Detroit's Big Three. The dismal U.S. jobs numbers failed to roil the market rally on Wall Street last Friday. Here us with more on the markets is John Chisholm, the investment specialist for global equities at Fortis Investments. His team manages around $6.5 billion U.S. dollars. Really interesting, John. We're seeing the markets up today in Asia despite the jobless report on Friday, which was really dismal.
Yeah, and we've become much more constructive in our views as of late. And when you look at the environment right now, you have massive amounts of monetary and fiscal stimulus that will be entering the system late in 2009, pushing an economic recovery out to 2010 with a market price recovery, say, 6 to 12 months in advance of that. So we are becoming much more bullish in our views in general.
So in general, are you saying it's a time to get back in because the markets have already priced in the bad news out there?
Well, in terms of where you look at the volatility, the VIX index back in October was spiking off 90. Then it was spiking off 80 in November, more recently off 70. And now we're seeing it at levels of 60. So in some respects, the panic is exhausting itself. The forced deleveraging is declining. And overall, you're going to need volatility to come down, and you need corporate credit spreads to tighten before you can see a meaningful equity recovery.
And you got earnings is still at risk. I mean, when you look at the emerging markets, it still is a levered play on the global growth scenario, isn't it?
Absolutely. We're very conservative in our emerging exposure, and you have to be, but in some respects, the growth story in emerging markets is not broken. It's just that there's still, the focus is cyclical concerns are ruling the day, and where you're seeing the earnings revisions coming down, it's in the commodity-related emerging markets and in the commodity sectors as well. So to the extent where you have structurally higher growth, additionally, you have lower debt levels in general in emerging markets, and at some point that is going to matter again, and valuations are attractive.
Well, interesting that you're heavily weighted towards the integrated oil companies. I mean, why are you doing that at a time when commodities are still falling?
Earnings visibility mostly. It is certainly, we never thought that $145 a barrel for oil was reasonable, but at the same time, at $45, you're now below the marginal cost. So when you look at the oil companies and the projects that they've taken on at, say, $80, $90 a barrel, they're incentivized at this stage to start cutting back on production and driving the price up again. So we're still in the integrated oil companies for defensive reasons, but we would at some point be thinking again about the E&P companies.
What about for the banks? Is it time to take a defensive position for banks, or wait a little bit more? Well,
banks are interesting. That's where we think you're going to make your money in 2009. The opportunities are great. Clearly, you're going to have a more difficult regulatory environment, and loan loss provisions are going to be higher and probably structurally lower ROEs. But at the same time, credit is no longer a cheap commodity, and there's a price on the loans that are being written now, so that banks are making money on the loans that they're writing currently for the first time in years. So there's a lot of opportunities in there, and the companies that are well managed, well capitalized, have been able to exploit the current environment, pick up their competitors at a dime on the dollar, and grow their business. So we're seeing a lot of opportunities there that could be very attractive in 2009.
Such as in Sumitomo Mitsui. I mean, it's one company that's based in a country that's now in recession. Isn't that a big risk?
Yes, certainly there's it is exposed heavily to the Japanese economy, but at the same time, it also has very defensible earnings in its book of business and a very attractive balance sheet. So they're growing their retail presence, and that's, we want to find banks in this environment with strong deposit franchises. So we do like the opportunities there. And another bank that we own in the region is DBS Group in Singapore, where there's in terms of where they're trading relative to their competitors, it's at a pretty nice discount right now. And additionally, looking at their aggressive cost-cutting structure, their numbers are coming in better than expected.
But when do you go big in the emerging markets? We're seeing a lot of fiscal stimulus measures, the rate cutting, and there's a lot of scope in cutting rates when it comes to the Asian central banks and fiscal stimulus measures like, say, India. I mean, it just cut rates over the weekend on top of the fiscal stimulus package that it introduced.
Yeah, you've got to see this aggressive easing within the emerging markets, and it's a situation where there needs to be more push on incentivizing the consumer in emerging markets, so to speak. It's clearly, when you look at the aggressive easing policies in China as well, it's the same situation where it's still very cyclically driven, but you'd need more of the consumer-led domestic growth to provide some sustainability to those markets. And in general, it's certainly an area where we're going to see a lot of attractive opportunities down the road, but currently the currency overhangs in a lot of these markets are still a bit of something to be cautious about.
What do you mean currency overhang?
Well, particularly markets such as Russia and in other areas where interest rates are coming down quite a bit and the currencies will be weakening, so you're going to have some currency exposure there, and certainly in other commodity markets such as Brazil. But as you move towards a domestic-led, a consumer-led domestic economy, there'll be a switch in that where there'll be opportunities more so at that level.
And when do you think that's going to come? Like in the second half of next year when all the fiscal stimulus measures come right into play?
Yeah, I mean, to some degree, but at the same time, as people begin to focus on the emerging markets and see that there is structurally higher growth and there's much lower debt levels, there's an attractive trade-off there relative to developed markets. And currently, in terms of where they're trading, I mean, they never should be really trading at a premium as they were in '98 and '07. But at the current level, it's more in line with their long-term average, where they typically trade relative to PEs in developed markets. So where there's higher growth and there's visible earnings growth, there's going to be good stock opportunities.
Good stuff. Thanks for that, John.
Thanks.
John Chisholm of Fortis Investments here in Hong Kong. Well, a longtime perk at Goldman Sachs is getting a makeover. A report says the bank is planning to end the monthly cash housing payment for Hong Kong staff. And the benefit won't exactly go away. Instead, the South China Morning Post says it'll be incorporated into salary or bonus. Goldman's bonuses this year will almost surely be lower, and senior executives won't be getting any extra payments at all. Once the biggest U.S. securities